And I got a call yesterday from one of my guys, said, I haven't received my payment. And I said, here's the deal. Kevin and I were on Zoom working. I said, I'm going to pull up our records right now. But if you have received that payment, I want a porterhouse steak lunch tomorrow. He said, you got a deal. He does this all the time. They do it all the time. This podcast is sponsored by Lend Private. If you want to learn how to make private money loans secured by real estate, go to lendprivate.us to download a free copy of the Private Money Handbook Lender Edition and check out the free Lend Coach Basic Training Bootcamp video series. We're looking for a few motivated individuals to join our Lend Fam community of private money lenders who want access to the training, support, and the tools necessary to build a profitable and safe private lending operation. And here's the best part. When you join the Lend Fam, we will fund your first deal. Go to lendprivate.us to get started. Let's go get them. Okay, today I have my pal, Dan Paloscio, SEP Capital out of Tampa, Florida, a fellow member of the Hard Money Bankers Inner Circle Mastermind, which is where we met a few years ago. Since then, he keeps doubling his balance sheet every year and growing, but safely and sustainably. So today I want to discuss, I'd love to talk more about your journey into private lending and how you've gone from some of your other business ventures into private lending and how you've grown such a beautiful, sustainable, profitable company.
Cool. Well, I appreciate that. I'm excited to be on. Long-time listener, first-time caller.
So you're the one.
Yeah. But no, it's been really cool to watch you grow and watch your business grow and bring in, new people, get them excited about private lending and I've watched your Facebook group grow. I've watched your podcast grow. So, it's been, pretty exciting to watch your journey as well.
Appreciate it.
Yeah. Yeah. And we have the Hard Money Mastermind to thank, I guess, for a lot of the relationships I have in this business. I guess before that, I knew one or two people that did it, but I definitely think that group's helped me out a lot. And, meeting everybody's been, really nice.
Well, one of the things I notice every time we're in a mastermind event, you take meticulous notes and you're listening to every speaker the entire time and you're engaging with every speaker each time. By halfway through the day, I'm checked out. I'm feet up on the couch and I'm just scrolling Facebook, but you stay so focused on everybody's model. And it appears to me that you're taking a lot of value out of each individual presenter and you're moving it back into your company. And as a new capital partner for SEP Capital, I have gotten a chance to go through a little bit of your system. And like I told you the other day, I'm just blown away by everything, the way everything is so meticulously put together from the marketing graphics, which I love, to the process of your document generation and dealing with your team as they bring a new capital partner into the system. Seeing that on the capital side of the equation for a change has made me very impressed already. I was already impressed with your company, but very impressed with your operational capabilities as the operator of the business. And I don't say that lightly because I know how difficult it can be to put together a lending operation and have every one of those 350 steps and all the processes look so clean and be so efficient. But it's bravo. I've told you that before, but bravo. And I admire you. And we're looking up to your company and we're trying to model a lot of what we do after the way you've done it. So keep up the good work on that end.
Yeah, well, I mean, coming from you, that's a serious compliment. It's funny because I feel the same way about you. When you sent, early on, you sent me over your doc sets of like how detailed every single step of your process is, and it made me look at my process and be like, hey, I can do a lot of things better. And you're right, I go to these masterminds and I'm genuinely interested in how everybody else runs their business because we seem to all do it differently. And we all do certain things really well. So we do one or two things in our businesses exceptional. And it's like even the fund model. I was really interested in the fund model, and there's a couple guys in the group that do that really well. And and every time I go, like I feel like, well, I'm not going to get as much out of it this time as I did the first time because I've got all this information already. But then I take a few things away and I get back and it's like, man, like it's dizzying the amount of things that I want to implement and I want to, roll into my processes. So it's, but I always leave there refreshed and energized, it seems, it would be, sometimes counterintuitive. You think you'd go there and then you just have all this stuff to do when you get back, but it charges me up. It's like it's exciting. I see how I can grow faster, how I can serve my clients better, how I can partner with our investors better, and it's yeah, I mean I think we're pretty lucky to be at the right place at the right time to all be a part of this group. I think we're going to look back in years to come and say, that was something, pretty special.
Well, I've heard you talk about your vision for your company, and it's very similar to ours. You're a little bit further ahead from a balance sheet standpoint and a growth standpoint. Let's just kind of give everybody an idea where you are right now. You have about roughly $20 million of your
Mhm.
capital and friends and family investor capital safely deployed in the state of Florida right now. Is that right?
Correct. We do infrequently we'll get outside of the state of Florida if the deals are exceptional, especially if we have the opportunity to partner with other operators in the hard money mastermind, as we've done in Texas. But so currently the portfolio is at a little over 20 million. That's leveraged against about 38 million in real estate, majority single family residential, and we do some small balance commercial.
So to give context for what that means, $20 million of friends and family's capital is lent out, secured against approximately $38 million worth of real estate, which means that the loan to value, the loan amount to the value of the real estate collateral is in the 55% range, which is very, very low. If you think about when you buy a house with an FHA mortgage, you have 97% loan to value. Daniel's portfolio is secured against a 55% loan to value ratio. By the way, Finley Capital's is between 54 and 55 almost all the time, which is, and anytime I read out our stats, I highlight that stat as my most impressive, my favorite stat. And the reason why we care, guys like us care about that, is because what that means is when our investors' capital is secured against real estate at that low of leverage, it means that it's very secure and safe. In other
Right.
words, we're going to be very unlikely to have a default or an operating problem that leads to a loss in principal. Even, God forbid, we have to go through an entire foreclosure process on a borrower. Because of those leverage ratios, our capital partners are in a very, very safe, relatively safe position against the real estate collateral. Is that how you see it?
Yeah, absolutely. It's probably the number one most tracked metric that I obsess over.
Mm-hmm.
And and you're absolutely right. Having that cushion in that loan to value, and on top of that, we're at 55% loan to value based on the evaluations that we do, which in a lot of cases are conservative. We tell our vendors, we're not looking to make a deal work. We just want to have a good, safe, quick sale value on an asset, so that we know if we need to have to default the loan, or if we end up in a default situation, we know kind of what we can get rid of it for. I generally know what the values are, just by looking at them, but we like to have a third party, evaluate loans that are, over the 50% mark. Stuff that's under 50%, a lot of times we'll just evaluate in-house. But we like to have a third party. But yeah, I think that's the most important. Second most important, I think, would probably be loan portfolio size. It's just an indication of growth. But keeping the loan to value low kind of insulates you from all other issues, and even more so, it motivates our clients to have a successful exit, even when the successful exit is somewhat painful. Because when you're highly leveraged in an asset, let's say you're at 80% or 90%, a small correction in the market, the client's underwater, and it's a business decision for them. Why would I throw good money after bad? And then they let the property go. But at 55% LTV, especially if a lot of that is sort of what's quote unquote skin in the game, the borrower's actual down payment money, what happens is even if they're going to lose 20% and have to, at the closing, they still want to protect the other 30% that they have in, whether that's their invested capital or potential income. So I find that even clients that don't have the best credit or not the best financial history manage to solve the problem to make sure that they, protect the sometimes hundreds of thousands of dollars of equity that they have in an asset. And, in the very worst case scenario, if we experience another 2008 or 1930s meltdown, and we lose 50%, we're barely underwater. And what ends up happening is we get to buy a bunch of properties back, at the very bottom of the market. We get to rent those assets back out, earn cash flow along the way, which at a lot of times is more than what we would be collecting in interest payments anyway. And we're in a situation that we would likely have bought in 2008 to 12. And we ride the wave all the way up to 2024. And now the properties are worth triple, quadruple.
I find that very interesting and kind of laughable when you describe the Armageddon worst case scenario and how the private lending business model, when executed properly, actually has a lot of upside in the event of a catastrophe. There's not a lot of other sectors where you can describe that. You can't I mean, you can't lose 40 or 50% of your stock value and be happy about that in any way because there's so much loss that you have to recoup before you have a profit, as opposed to in this scenario because of the way that we structure our deals and our loan to value ratios. We have the Armageddon protection baked into that. Not to say that we want that or that it would be good, but in most other sectors, you go to zero, you get wiped out if you have a catastrophic change shift in the market. I think in the private lending space, it would be difficult, but it would be no more difficult than any other industry. And in many ways, we have contingency plans around that Armageddon scenario, which is wild. Uh,
Yeah, I mean, you look at 2008 and you look at some of the largest brokerages in the world, Lehman Brothers,
mhm,
they went bankrupt overnight.
mhm.
It's easy for a stock to go to zero. It's in the history of the American real estate market, you've never had a market go to zero. You've had the biggest crashes in our history were '08 and 1930, and we lost, roughly 50%. But it wasn't a 50% that happened overnight either. In stocks, that crash happens quick. It turns on a dime. It's like a motorcycle. It's agile. Real estate, the market turns like a cruise ship, very, very slowly. And so in 2008, we were at the peak and you saw a decline from 2008 to 2012. So we didn't lose 50% from, March of 2008 to April of 2008. We lost it over a 4-year period. And so us as private lenders, we have an opportunity to adjust. Right now, I think that we are in a little bit of I don't want to call it a declining market, but we're in a correctionary market, if that's even a word. And so I think that what we're doing to sort of combat that is we're being a little bit more conservative than we normally would, right? And we want to keep that loan to value a little bit tighter to account for the fact that, hey, things may continue to move downward as we correct, especially in Florida, considering so many people moved to Florida during COVID. Our prices were just insane. Demand went way up, but supply it went way down. And so, supply and demand is the basics of economics. And so, uh, you know, now we even see with the floods, all of these, homes that were affected by some of in all the coastal areas.
Mhm.
A lot of private lenders were rushing right into those with their clients. Their clients said, "Oh, I've got this great deal. We're buying it 60 cents on the dollar," but they're using comps prior to the flood. And so, hey, I agree with you. That was a great deal 6 months ago. But now that you have thousands of properties on the market at the same time, you're no longer in a seller's market whatsoever. And so we've seen property in some areas come down from, 900, a million, for dirt, come down to about 450,000. We've seen in some areas of the beaches, um, lose about 50% of value. And so we take that into consideration. We're not doing 50% LTV loans in those areas. We're doing 20, 30. Sometimes we're not even doing rehab loans because a lot of our clients are struggling with the FEMA rules and regulations. And so we're very conservative into going into situations like that. However, I do believe that in the coming years, uh, that whole area is going to change, and I do expect those areas to increase significantly on average because they're tearing down these old $1 million sort of bungalows and they're putting up $4 or $5 million mansions. And I think over time, that's going to increase the value overall. But for anybody who's going in looking to flip and get in and out in 6 months, I think those people are going to have a really hard time exiting. And we coach all of our guys. We're very clear about that reality to them because investors, and I'm an investor as well, where I have been a real estate investor all of my career. And I know that going into some of these deals, you have rose-colored glasses. You see all of the positives and you kind of overlook the negatives because you want a deal to work. Our jobs as underwriters, on the other side, is to find all the reasons why a deal is not going to work. then hedge against that. And so, a lot of our guys that brought deals to us, and we're just like, hey, I don't think you're going to come out of this okay. I think if you're going to do it, you should offer this, or you should be at around this much. And some guys say, hey, I just really want to do it. And I say, well, we'll do it. I would advise you against it, except I'm not Nostradamus. I don't see the future. So, but I'm only going to lend what I feel comfortable. And I think that that's kept us safe. And like I said, the slow moving reality of the real estate market sort of affords that, I think, luxury versus a lot of other asset classes or a lot of other, investment opportunities, especially I don't love the stock market, I don't love the idea that your money's here today and poof, it's gone tomorrow.
Well, speaking of money, what is your average loan amount? And I've noticed from looking at your portfolio, your loan portfolio is very different than ours. And I think that's a product of where you live versus where we live and the type of clients we serve. But it's been my experience looking at your portfolio. You have a lot of cross collateral deals with maybe a $500,000 and an $800,000 property with $1 million property, and you're lending $750,000 against $2 million in assets, and they're taking that $750 and finishing a project somewhere, or so these much bigger scale transactions. Is that still the case with your portfolio makeup?
Yeah. Yeah, I think there's a lot of positives to the Florida market. There's some negatives, but the big positive is that it is a market that's not super inexpensive. And so just by way of our loan sizes being bigger, we can make a little bit more money with a little bit less effort. And so our average loan size, I think, is somewhere around 330 to 345,000, give or take. We've got 59 loans on the books. Um, and we do a lot. We do a lot of bridge lending, I would say, compared to fix and flip loans, which is what a lot of the guys do in the group. The benefit of that is sometimes, you can charge a little bit higher fees. Our clients aren't as rate and term sensitive. A lot of our clients are business owners, they're just tapping into some equity in a building that they own. The negative to that, though, is we don't have as many repeat clients. What's nice about fix and flip clients is when you get a good operator that knows what they're doing, they may do 10, 20, 30 deals a year with you. And we don't see any of that. And so a lot of our focus is, spreading, going sort of wide in a market, trying to connect with as many people as we can and, be that backstop for people when a deal falls apart or when they need a quick decision, that they've got somebody to go to at the 11th hour. We kind of pride ourselves on being able to close same day if title's done. And so, we've been able to kind of carve out a little bit of a niche in our market for that, I think.
A lot of people don't understand what a bridge loan is and what the purpose of securing a bridge loan as a borrower is. A lot of times I'll hear people say, well, these are for loans for people who can't get money any other way. And there's a little bit of a derogatory term, but in reality, just put yourself in the position of a small business owner who owns a couple pieces of real estate for 30 years and they're worth $2 million and you've gotten them all the way down to no debt. And you have an opportunity that comes along in some other aspect of your business or another real estate purchase or whatever. And you have to move quickly on that. You can't go to a bank and get $500,000 in less than 45 days, typically. Right? This opportunity might be, hey, I need to close on this next week. Or you might have gone to a bank and the financing might have fallen through at the last minute, or they needed another extension that the seller wouldn't offer. There's a lot of reasons to call Dan at SEP Capital and say, hey, I need $500,000 by Friday. I'm willing to pledge $2 million in unleveraged collateral that's in great shape. Can you help us? And the answer is, yeah, you can do that deal all day long. It's a 25% loan to value. You can close it in a couple of days. You can underwrite the deal quickly. There's not a lot of risk there. The only real risk, if you will, is borrow repayment. So you have to understand how they're going to repay. But God forbid they don't repay, you're foreclosing on $2 million worth of assets to get back $500,000. Now, you can turn around in that scenario and go to a capital partner, okay, and say, hey, if you have $500,000 that you're trying to deploy and you're trying to get a yield on, but you're also trying to do it safely and secure it properly, there are not that many places. You can't even think on more than one hand how many places you could put $500,000 and be very likely to earn your double-digit return, and do that in such a way where you have a partner that knows exactly how to handle all this and put it all together and secure it and protect it. But if you think about that deal, if you have $500,000 laying around and you know a guy like Dan and you've gotten to know him a little bit and you've watched him do some business for a couple of years and you see that he's legit and he's not a scam artist and he's not making bad decisions, and you start listening to his show and you realize how he thinks about loans and how he thinks about securing investors' capital and whatnot, a deal like that becomes very attractive to a savvy, sophisticated capital investor. And I think that's in part how you've grown so quickly, not so quickly, but pretty quickly, from a low balance sheet of just your own capital all the way up to $20 million. These are people who trust you to partner with you and to participate in these loans. And it speaks volumes to me that you've been able to raise that much capital and protect it for your capital partners. I know about this because I do the same. We've paid over $2.1 million in investor interest to our capital partners in the past 3 years. And you're nodding your head because you know how proud that makes you, when you can do that. And we just recently became a capital partner for SEP Capital, because this is what happens, friends and family. You have a beautiful $20 million balance sheet or a little $10 million balance sheet like we have right now. And what happens every day is there's this little seesaw game. All of a sudden, Dan funds all his deals, and then he gets a call for a guy that needs $500,000 against $2 million in real estate, but he's got to close it by Friday, and today's Tuesday. Well, Dan can't make money come out of thin air, so he has to figure out ways to, quote unquote, raise that money or find partners who want to invest in that loan quickly. And sometimes you make your calls. You got 5 or 6 guys that you've been talking to, and hey, I got an opportunity. They say, I just bought an apartment, or hey, I can't get it out of my 401k that quick, or whatever. And so what we've done is we've just become a backstop on this opportunity. And Dan called me up. Dan's called me up a couple times to say, hey, I have opportunities. And I've said, I don't know, buddy. Your little daughters are beautiful, but I don't know yet. You never know. Look, the truth of the matter is, this is, in my mind, I don't know, this is for me anyway. Maybe you can relate if you've made investments with other people. You're asking capital partners to trust you. And this trust word is a hard word for me. I don't know if you've noticed that. It's just tough. It's tough to really trust people with your money. So the question becomes, go ahead.
One step further, I find it easier to trust people with my money than I do with other people's money.
Sure.
For me, it's a much higher bar and a much higher level of responsibility.
Yeah.
I've never lost money on a real estate deal in my life. And more importantly, I've never lost principal or interest for any of my capital investors at any point in time. Like you mentioned, over the last few years, you've distributed over $2 million in interest payments to capital investors. And over the last 12 months, we've done, I think, 1.3 million. That's one of the things that I'm more proud of. I tell the joke all the time that at one point I started a property management company and sold it to my partner, majority share of it, so I could focus on this full time. But in that business, I always felt like I was the bad guy. I felt like guests were upset with us because they always wanted discounts. They were not happy because their lawn guy was cutting the grass at 10 a.m. on a Saturday. And property owners weren't necessarily super happy with us because they paid too much for their property one time. Their mortgage is high. They're not making their bills. Their expenses are too high because we have to maintenance the property. It just seemed like I was in the middle of a lot of people being upset. What I really like about the business that we're in is that we get to be the good guy almost all the time.
Mm-hmm.
We get to be the good guy because our clients come to us with opportunities and we get to help them realize those opportunities. They make money because of us. And we get the opportunity to help our capital investors earn a safe return on their capital, which is, earning, the types of returns that you can in this business with the security that you have. It's tough to find. It's tough to find. There's some, shiny objects out there, shiny opportunities that pay more, but they come with a lot more risk. And look, my mom is an investor with us, my sister, my fiance. All of my first investors were friends, family. They were hard money lenders that I, as a borrower, borrowed money from.
Mm-hmm.
And so, I take, a lot of pride in the fact that, I'm able to help people on both ends of the equation. And also, I like being liked. And so I find it to be a much happier business model than the short-term rental business.
Well, you're making a joke, but in reality, there's a lot of truth to that. There's a lot of fulfillment that comes from distribution day when you send the capital partners their distributions,
Mhm.
and you build those relationships, and there's mutual respect and admiration and appreciation. And for the most part, as long as you have the right capital base, there's not a lot of friction. I got a call yesterday from one of my guys, said, "I haven't received my payment," and I said, "Here's the deal." Kevin and I were on Zoom working. I said, I'm gonna pull up our records right now. But if you have received that payment, I want a porterhouse steak lunch tomorrow. He said, "You got a deal." He does this all the time. They do it all the time.
Yeah,
So of course, he looked at the bank account, and then he checked the other bank account because he's got two different investment styles, and one of the investments was in one bank, and the other was in the other bank, and it was right there on time. And the reason I was so confident that I knew the payment would be out there on time is because my controller, Josh, is so incredible. He never misses. There's never a payment that gets missed because this is such a finely tuned operation. So I was a little smug with him. I was having fun with him, but I said, "Hey, porterhouse, medium rare, all the fixins." Because I
yeah,
guarantee you, your payment is in your bank. And sure enough, it was right there, and we found it. He's okay, fine, I buy you a steak. But the truth
that's great.
is, we have so much confidence in our operating capabilities at this point that if a capital partner ever calls up and says, "Hey, I'm not sure we got a payment, or I'm looking for something," it's always there. And one of the participation agreement co-lender model where you hop into a loan in mid payment. There's sometimes a payment variance between the first payment and the last payment, and when the first payment comes in, and then it turns
For
into a
the
monthly
year.
payment. You know what I'm
Yeah.
talking about. I have a couple, especially new capital partners, that are doing multiple loans in that model, and they'll call up and say, "Hey, can you help me understand the 6 payments we've received in the last 3 months?" And
Mhm.
and my Josh will just get on an email, and he'll break it down and help them understand, this was 16 days of interest at this rate, and your start date was this date, and this was your investment, and this is the return, and da, da, da. And every time I get this, "Oh, thank you so much for the clarification email,"
Mhm.
that I get CC'd on. And that makes me feel really good, as I'm sure it does for you. But let's talk about the emotional hesitance and the faith and trust that it takes to make a capital investment into a company like SEP Capital. And I can speak from experience now because I've just done one.
Mhm.
And I will tell you, listening, if you're thinking about investing with a private money lender like Finley Capital or SEP Capital or any of them, it really comes down to the person you're sending the money to at the end of the day. He or she can do right by you, or he or she can do wrong by you. And so you're really underwriting the operator, the character, the capacity of the operator, and obviously the system. Uh, so it takes a little bit. It takes a little bit of time to build that trust and have enough perspective to say, this is a risk I'm willing to take, and I'm willing to send. Obviously there's the risk of the deal that you're in, but really it comes down to in my mind, the operator and whether he or she is competent and trustworthy to do a good job and be a good steward of your capital. Now, it's no different than when you pick a financial advisor. It's no different than when you pick a bond, and the same kind of concepts apply, but it just feels a little different when you're making this kind of alternative investment. So how do you help your potential capital investors feel more comfortable to take the first step of doing their first deal with you as a partner?
I think the most important thing is just transparency. We're a fully open book. If someone wanted to, even when I'm onboarding new capital investors, I like to explain to them how we make money. A lot of people talk about, hey, you can earn this return. This is what you'll make. This is, these are the types of deals that you'll be in. I think it's important for capital investors to know how we make money, to see that we have a viable business, to see that we're incented to do things the right way and to continue to grow things, right? And so we go over the origination fees, we go over the yield spread, we go over the late fees and all the miscellaneous fees, and we'll get as in-depth as some people want to go. Some people just want to top line information, and other people, based on their personality style, want to know every single thing that they can know to feel comfortable. And so we're an open book, and I think it's important to maintain that level of transparency from start to finish. Some of my capital investors will call me and they'll ask a question about the statement, or, hey, sorry to bother you. And look, don't ever be sorry to bother me, and don't ever feel uncomfortable to ask me a question about the financials or about your loans or about anything, because it's my job to make sure that you understand, and it's my job to let you see inside just as much as it's my job to ensure that you get a payment every month. I think that's the most important thing anybody can do in any relationship, is be transparent, right? But then the other part, I think you mentioned, you're sort of betting on the jockey a lot of sense in private lending. I think that there's also a bet on the horse, and the horse is the deal, right? And for us, our model, specifically direct placement, each investor gets the opportunity to evaluate the deal for themselves before they make a decision. It's different than the fund model where you send your money to the fund, and it gets allocated across a bunch of properties, and you kind of just go with the flow. In the direct placement model, before you invest in a deal, from us, you're going to get a new loan package, and that's going to include an appraisal or BPO or opinion of value. It's going to include a deal worksheet, which tells you all the information about a deal. It's going to include the loan documents, and so you get to underwrite this deal as if you were writing this loan yourself first, and then if you like the deal, you get to go forward on it. I think the key about both of us is that we're pretty strict about the types of deals that we do. And I think we follow one rule ultimately, and that's loan to value. And so if you like one of our deals, you're probably going to like all of them. If for some reason you don't like one of them, it's likely you're not going to like all of them. So it becomes a very streamlined and easy process over time. But I think that's one of the things that some of our capital investors like is that a lot of our capital investors are have some sort of experience in real estate, it seems like, whether they were my old hard money lenders when I was flipping houses, or whether they were real estate investors themselves, or whether they have just a general understanding of how real estate works. And so I find that for people like that, this model works really well because they get to kind of see what they're investing in and make the decision themselves. And maybe it even sort of, solves some people like to be involved in deals. Some people like to do deals. I like to do deals. I think it's a little bit more exciting for me that you get to put these loans together. I think if you put me in a scenario where I was lending, I would kind of, drink my coffee in the morning, look at the opportunities that are available and decide on what I want to do versus just, oh yeah, check my balance every month. And so I think that together kind of goes a long way with, making people, understand what we do.
Hey, if you're enjoying this episode, then join us in our free Facebook group, Powered by Private. It's a community of new and aspiring lenders who want to learn more about how to safely raise and lend private capital. Okay, back to the episode. Let's go get them. So this direct placement model that you reference, what that effectively means is that we'll go back to this $500,000 loan I keep referencing. Daniel goes out and originates this $500,000 loan against $2 million in real estate. And he puts the whole package together, the value, the loan terms, the structure, the borrower profile, all the different details of this deal. And then he says, hey, look, would you like to participate? Would you like to be a participant, an active participant, frankly, in in this loan? And what that means is that the capital investor can analyze the deal actively. He or she can underwrite it actively, as opposed to buying into a fund, which I'll get into in a second. But he or she can look at the details of this loan and make a active participating decision whether he or she wants to participate with Daniel, because a lot of times Daniel's capital is in that deal alongside the capital partners, which I'd like to talk about as well. And what that means is that you have the opportunity to basically partner with Daniel, and then he has what he calls a participation agreement, which is a governing set of documents that spells out the terms and the conditions and the rights and the responsibilities of each party, and who gets what revenue from which sources and how that's distributed and dealt with, and how decisions are made in the event of a problem and whatnot. But then you get to ultimately decide, I like that deal. That deal makes sense to me. I can understand that deal. And when I invest my money into that deal, I know exactly where it is. And when that deal repays, I know exactly where that money's coming back from. A lot of people find a lot of comfort in that, knowing that they can track their dollars to a deal secured against a piece of real estate, and know that there's a very specific or relatively predictable repayment time frame for that capital, which allows them to recover it. In many cases, if you invest in a fund, there's called a lockup period, and this is a period of time where you are not able to recover your investment. You have to wait sometimes a year, 3 years, 5 years, 10 years. Sometimes these funds lock your capital up for a long time. Many of them have a repayment clause where if you give them a certain period of time, they can exit your capital, and that's nice. But these direct placement deals are interesting in that, based on the maturity date of that loan package, roughly give or take a month or two, usually that capital is going to come back. And then you as the active partner get to make another decision where your capital goes in next. When you look at the fund on as the alternative investment option, which by the way, I love the fund concept, but what that would look like instead, if Daniel puts together a 506B or a 506C registered fund, then you could take your capital and invest it in that fund. And then that capital will be distributed across the entire portfolio because all 59 of Daniel's loans, all $20 million of those loans theoretically would be owned by the fund, and you would be a limited partner owner of that fund. In other words, you would own a proportionate share of the fund assets, which is cool because it gives you just diversification across a wide range of properties as opposed to, a little bit more systematic risk of the downside on each particular deal you do. If you ask 10 different investors which investment opportunity they prefer, you'll get 10 different answers, which is interesting to me. But regardless, the direct placement model has a lot of benefits. And I think the main benefit, or one of the main benefits, is that active participation, that active underwriting ability to look at the deal and make a decision. But like you said, Daniel, if you like, the structure of this loan opportunity is going to be similar to the other loan opportunities that you do because you create such a standardized loan approval process that once a capital partner gets the hang of it and they see a deal, the deal comes back and they see a deal and another deal comes back, before long, they start to kind of be a little bit less, detail oriented on the deals. And it's more a matter of, hey, what's the next deal we have? That's good. Does it look good? Okay, let's get in that one. Let's keep going. Then it becomes a matter of putting more capital in and letting the returns compound and things like that.
Yeah. Yep, I agree. I had a capital investor the other day, one of my first capital investors actually, that was just making a joke that, I send him the documents and he says, I don't even read these things anymore. I don't know why you send them to me.
You know what?
Sign up.
That is so true in so many cases. And it's not a matter of, not being diligent. It's a matter of trust. So much
Right.
of the transaction, of the percentage of the transaction, turns into a ratio of trust versus underwriting.
Mhm.
You've been doing this for 3 or 4 years. You've done it hundreds of times. You haven't had a problem. Your capital partners have been in and out of deals. We have some capital partners. I have 2 or 3 7-figure capital partners, and at this point, they still underwrite. They still review deals, but we send them deals, and when their capital comes back, we stick it in what's called a holding tank, which is an escrow account. And so as soon as 500 grand comes back in, we put it in the holding tank, and then we call them up or we email them and say, hey, we just got repayment of 500 grand on XYZ property. Would you like us to redeploy? And 9 times out of 10, they say they do. And sometimes they just, at this point, don't even ask. They just say redeploy. So we'll say, okay, here's a 200K loan and a 300K loan. We can get everything out on these 2 loans. And here's the assignment docs. Here's the files. Let us know if you have any questions. And then they sign it, sends it back. We take that 500, we redeploy it. And that creates more stability for our balance sheet. It creates more ability to forecast capital coming in and out because we know, hey, if this 500 grand comes back in from a loan repayment, we know that they want to get that back out. But if we have a capital partner that wants to go do another project or has another issue or whatever, wants to get out of the deal, we can either buy their position out if we have capital available, sell it to another capital partner if they want to get in, or just wait till it gets repaid, worst case. And then when it comes back in, that capital is now available for that capital partner to go and divest it or do whatever they want. Pretty interesting.
Yeah, we have the exact same model. That's fun. And that's nothing we've ever talked about. It's funny how we all converge on some things. Some things just make sense. But yeah, and that's another thing that's great about this model. Like you said, there's pros and cons to both. I do like the fund model in terms of the diversification. I like that everybody's sort of invested in every loan. And I also like that proceeds can be rolled back into the fund. I have a lot of capital investors that ask if they can do that, but with the direct placement model, it's not really possible. We would have to sort of place them onto each payment onto each individual loan, and we have 59 payments a month, and for small amounts, so I'd be placing 1,200 here, 5,000 here, 2,000. So it makes it a little cumbersome. But having the sort of liquidity, I guess, of the direct placement, knowing that loan's going to pay off usually before the expiration date or the balloon note date, and you have the ability to decide at that point if you want to put it into something else or keep it rolling. And I've had very few investors ask really honestly, to take their capital back. I've had a few, and then they end up reinvesting it back with us. The deal fell apart. We were going to do a real estate deal or something. Because look, investing in real estate too, it's on paper, it sounds like a better idea. Oh, there's appreciation, there's depreciation, there's cash flow, but it's like identifying an asset in this market is really difficult, you know? And I have a lot of real estate investors that have money just sitting with me, and they tell me all the time, "Oh, I may have to, pull some money out to do this deal." It's just the deal doesn't always come, and it's not always rosy, and it's nice collecting just a fixed return annually or a fixed return monthly. And it sometimes is the easy. And I know the goal for me, as you mentioned, I'm the largest investor in our portfolio. That may fluctuate month to month based on payoffs, but as it stands right now, I'm definitely the largest investor into my portfolio, and I continue. I want to continue to grow that because ideally, um, I'd like to have a large portion of the portfolio, and then maybe just be a capital investor. You know, not have to sort of. I shouldn't say have to, but only work on the deals that I want to work on, spend time with my family on the days that I want to spend time with family, travel when I want to travel, but no, but earn more money, you know? Jason and Chris always tell the story about early on, and it was true for me. Um, at, at one point, I wasn't investing in the portfolio, and one of my capital investors, I looked at as we were doing 1099s at the end of the year, made more money than me by being a capital investor after I spent all this time and energy doing the work. And that was sort of an aha moment for me right around COVID. And I had, a lot of money sitting because I was waiting to invest into a real estate deal. It's just everything was crazy and I didn't trust the market. And that was just an aha moment for me. It's, hey, you've got to get more money into this. And I think that the velocity of that over time is just going to continue to compound. And um, that's the goal for me, you know. I don't know that I'll ever have money in stocks. I have a little bit, and it's just kind of for the casino to me. That's what I look at it as. And I think it's just, grow, build a portfolio over time. If I can help, if I can bring people along with me that want to go along, then that's great, you know. But the goal for me is ultimately to just have enough money in the portfolio that I can live the lifestyle that I want to live and have the kind of freedom that would afford and not necessarily be doing originations and taxes.
Well, one of the main, one of the ways that it becomes attractive to make an investment with a private money lender like you is knowing that you have skin in the game. So one of the
Mhm.
things that I do with especially new capital partners, I'll say, look, if you're interested in making an investment into a private money loan with Finley Capital, I will go right with you on any deal you want. So I'll go 50-50 on any deal that we decide to do. So if you want to put in 100 grand on a deal, we'll put in 100 grand on that deal and we'll be your partner on the deal. And I think that creates a lot more confidence and for the capital partner when they realize, hey, we're putting our money where our mouth is on a deal. We're not just saying, hey, this is a good loan, you should take this one. We're saying, hey, this is a good loan, you should take this one with us. And I think that
Mhm.
creates a lot of confidence and a lot more trustworthiness when they know that you have an actual financial interest in that particular transaction, which at scale is impossible to replicate on all the way across the board. But especially in the first couple of deals, when you have a new capital partner who's a little bit hesitant to take the leap of trying this, you should say, look, I got a loan coming up. I think it's a great loan for you to start in. It's right in your backyard. You get to drive by the house if you want. You can check it out. You can watch the progress. And I tell you what, if you want to take half of this loan, I'll take half of it. We'll be partners. We'll do it together, and we'll start our relationship that way. That's been a good strategy, especially for helping new capital partners get interested in the idea. But I'd like to talk about how you help new capital partners feel comfortable getting into business with you, and also where they come from and what they look like. So, for example, I have several capital partners who are 100,000, 150,000, 250,000, even 50,000. I have a couple that are a couple million, but I have a lot of capital partners who are just hardworking people who have put away some money over time. They're not multimillionaires, and they're looking for ways to diversify their portfolio away from the stocks and bonds and the mutual funds and the things that they already have. They're
Mhm.
interested in real estate. They don't want to go out and create a lending company, but they do want to deploy their capital and try to get a higher rate of return than in other, safer investments, if you will. And so they understand, the marginal difference between a 4% bond and a 9 or a 10%, yield on a loan. But they still have to understand how to vet and underwrite a deal and a borrower or in an operator. And so how do you take somebody like that, a bank, let's say a guy that owns a construction company or a plumber or whatever, some working, small business owner or retired people, maybe they have a 401k that they can an IRA that they can self-direct, things like that. How do you sit down with them and make them feel comfortable with what you're doing? What would be that process, step by step?
Well, I'll be honest, up until this point, the majority of the capital that we've raised has been sort of referrals or, like I mentioned, hard money lenders that I was a borrower of for years. And so I kind of started with a baseline of trust. I think none of this happens without trust. We have brought on new capital investors. We're sort of selective with who we bring on because we want people to really understand what we're doing. It's really important that they understand the process and that they feel comfortable. We're really careful. I don't like to be sold. I don't like to be sold on anything. Like I am a data guy, I guess. If you can tell me what things in sales, they tell you never talk about features, only benefits. I think for me, benefits make me skeptical. Don't tell me just tell me what these things do. Don't tell me what they could do for me because I become skeptical of things but I might be the minority. Not everybody, wants that type of communication. My personality trait sort of wants very direct and clear communication. So I don't sell. I don't like to be sold, so I don't sell people. What I like to do is I like to lay out the facts. I like to lay out the opportunity, be as transparent as you can possibly be. And then ultimately they'll make the decision as if it works for them or not. Everybody has questions, and so questions come up, you answer the questions that you can. And if it's something that people are interested in, have an appetite for, they move forward on it. And if it's not for them, then it's not for them. I find that the people who do determine that it's for them more often than not are people that at least have a general understanding of real estate. When they have a general understanding of real estate, in some of our some of my capital calls, I guess, with new investors, we'll get to the point where we discuss loan to value and how things work. And I'll go over kind of where our portfolio is and what the loan to value is, and especially on the deal that they're looking at. And they'll say, oh, so, it's worth $1 million. You're lending 400 on it. And they'll say, oh, I hope that they don't make their payment. And then when they say that, I kind of know that, yeah, this is someone who gets it. And it's going to be an easy process. Like they understand that if they don't make the payment, we take back $1 million asset that we only have 400 into it and we sell it for, 700. And more often than not, I have to explain to them, we're not going to get the property back because it's going to sell at foreclosure auction, but we are going to earn default interest along the whole way. And so I just try to, connect with people that understand what we're doing and want to do it.
Let me go down that quick rabbit hole right there because you hit on something that most people don't understand. If it's a $400,000 loan against $1 million asset, what's exciting about that is we know that in the event of a default, all the way down to foreclosure, we are going to be made whole and then some. But let me break that down because people don't understand. They think if you lend $400,000 against $1 million asset and if they default, you get the asset. What would happen instead would be there would be a process, a foreclosure notification process, which would take several steps. And in Florida, it's different than Michigan. And Michigan takes forever. Florida's probably faster. But there's a process.
Florida's not very quick.
No?
That's one of the cons of Florida.
Well, there's no redemption in Florida, right? So once the foreclosure is over.
There is a redemption period, but it is short. The redemption period. I'd have to touch with my attorney on that, but it's not a long period.
Well, I haven't done a foreclosure in Florida, but I used to live there. I used to buy them. So this is 20 years ago now. So I guess I don't know what I'm talking about. But I know in Michigan, there's a foreclosure and then there's a redemption period of 6 months, which means that that borrower can redeem that loan for a period of 6 months. So when we do a foreclosure, we can't take clear title to that and resell it for that period of time, which makes it a nightmare. But let's go through this exercise. In the event that borrower defaults, they're going to get a demand letter. They're going to get a notification. And then at some point, it's going to be referred to an attorney who's going to start a foreclosure proceeding, which is going to initiate a series of legal steps and notifications and court dates and all these different things. During that period of time, I doubt the borrower is going to be making payments. So the capital partner in that loan, along with you, are not going to be receiving interest payments during that period of time, which could be a couple of months to several months to even longer, theoretically. This is the downside risk of these investments. So your capital partners need to understand what happens in the event of a problem like this, which is possible to happen. Now, it's not very likely to happen because it's very unlikely that a borrower is going to default on a $400K loan against $1 million asset, but it isn't impossible. It can, and it eventually will happen. So you, as the partner, are going to be primarily responsible for coordinating the legal, engagements and legal steps to go through that process. Eventually, it'll go to a foreclosure sale that's initiated by the municipality that's in which the property resides. At that sale, you and the partner, as the lenders, can through a statutory limitation, can say how much is owed to you. And the way that that's calculated is loan balance plus unpaid interest at what's called a default rate of interest, which is stipulated in the mortgage and the promissory note. What happens in the event of a default? The interest rate that the borrower owes goes from X to much higher, and there are some fees you can charge, legal fees and whatnot. So that amount, the unpaid balance of principal plus those unpaid interests at the higher rate and the fees and all that stuff, compound into a total minimum bid. And of course, you as the lender can lower that, but you wouldn't in this scenario because you just leave it like it is because you know there's somebody going to buy it. So what happens is Joe investor comes along at the foreclosure auction steps and says that loan has a payoff of $426,500 and it's worth $1 million. I'll buy it. And then other borrowers will likely compete against that borrower, and it'll drive it up to 500, 600, 700, 800. Now, if they buy that for that amount, I'm not sure exactly who gets the proceeds above and beyond the payoff, but I believe it goes back to the borrower. No.
So it's actually funny that those proceeds do go back to the borrower, but I believe that the borrower has to request them. I think they go into an account. And it's weird because some people don't know that they can reach out to the county and get that money. I don't think it's an automatic thing, but correct, it doesn't come to us as the lender. We don't receive that. We receive what we're owed. You can do a reserve, which you could sell for less if you wanted to, which we wouldn't be in that situation, which is why you go low loan to value on these things. But yes, you would recover your principal, your interest, default interest, attorney's fees, NSF fees, late fees, any of the other fees,
maintenance, taxes, insurance,
payments, taxes, insurance. Insurance is important. Insurance, which many times when they're not making their payment, they're not renewing their insurance policies. So we have a forced place line of credit or a forced place insurance line. And so we recoup all of that, and all of those things accrue at the default rate, which our normal interest on loans are generally 12%. For loans under 500,000, our default rate is 18%. And for loans above 500,000, the default rate is 25%. So that means if we end up in a default scenario let's just make easy math, on $1 million loan, it's accruing interest at 18% a year, 1.5%, or excuse me, 25% a year, more than 2% per month. And then at the closing table or at the foreclosure auction, all of that gets paid back.
Yeah. So the example I made was a little extreme because you don't usually see scenarios like that where there's that much equity, but more than likely, Daniel and his capital partners are going to be able to have enough equity at that sale to compound all of their legally entitled to fees and interest rates like he just described, and actually recoup that as income from the buyer who buys that property because he or she sees value in that property, even at that $450,000, $460,000 balance owed. So what that means is, and none of us want this as capital partners, as operators. We don't want to deal with foreclosures because they're a headache, they're a hassle, they take a long time, they're stressful, and you have to outlay attorney's fees to get to that point. And that might be $10,000, $15,000, $20,000, which you and the capital partner or the capital partner got to figure out how to pay for. But at the end of the day, at the end of the Armageddon scenario, when that foreclosure occurs, everybody gets made whole. So again, this is a downside risk scenario, what it looks like in the event of a downside risk. But because Daniel structured this loan so conservatively, the ultimate outcome is highly profitable for both Daniel and the partner. It takes a while to get through, some stress to get there. But that's better than being in a scenario where he lent $950,000 on $1 million asset. That goes to foreclosure, and now he has to take it to the foreclosure auction and put it for sale for $700,000 because nobody's going to pay 95% of its value as an investment. And so somebody's going to be writing down $250,000 plus fees and plus lost interest because he over leveraged the loan and because it went into default. And which I laugh so much when I think about these, securitized portfolios of residential mortgages that are leveraged to the hilt, but somehow are safer and, than what we do, which is ironic. But at the end of the day, the point here is that because of the way Daniel structures these deals, in the event of a worst case Armageddon foreclosure outcome, the capital partners still get made whole and they actually have an upside benefit of the interest, but it's not as sexy as it sounds where you're going to get $1 million, $600,000 in equity. That's not how it works.
Yeah. Yeah. It would be nice if you could until recently, it was people called this the loan to own model.
Mm-hmm.
But if you're making loans at the right loan to value, it's very unlikely that you end up owning. I've been doing this for a number of years, probably 5-6 years that I've been, lending hard money. Really since probably 2015, I've been lending hard money, doing it as SEP Capital for the last 3 years. But throughout all this time, I've had several defaults where people get off track and then they usually get back on track or they sell. And that's why you need that equity. So that option is available to them. I've had one property go all the way through foreclosure and we were 55% LTV on it. And the borrower, I had somewhat of a more than just a borrower relation. He was an acquaintance. We were from the same town. And so I used to see him at restaurants and I offered, he was in a fix and flip loan. I offered at this point, I was assigning notes to investors. And so I offered to buy the note back from the investor if he'd be willing to quit claim it to me. I told him I'd finish the rehab. And then I told him I'd split all the profits with him 50-50. And he just didn't do it. He was very stubborn. And I still to this day don't know why he didn't do that. And it was amicable between us. He reached out. He wanted to do more loans with me after. And he went all the way through foreclosure auction. We earned and it happened, I think, during COVID. So we were in foreclosure for about a year. We earned 18% default interest throughout the whole way. The property sold at auction. And we moved on. And in hindsight, it was at a condo in Bel Air Country Club, which is, I think you played there with us when Mastermind was in Tampa. It's a great country club. I wasn't as much as into golfing as I was, but owning one of those condos skips you to the front of the 5-year wait list to get into that club. And I kick myself now. I'm like, I really wish I would have
made that deal.
Figured out a way to own the property because I was a social member there, not a full golf. And but at any rate, it worked out. And we jokingly tell our capital investors that in almost every case, if we go to foreclosure or default, our position advances. It's not like you mentioned, it is a headache. People not answering the phones. It's a drain on time more than anything, and it's doing something that it's like again, you have to be the bad guy. It's not fun being the bad guy. And so I like to avoid that at all costs. But what's the old adage? It's, talk softly, but carry a big stick. So I think that's sort of the scenario.
Well, speaking of big stick, there's another element to these loans that we structure that adds further protection for the capital partner. And that is, we're talking a recorded mortgage, obviously, for one thing, but a personal guarantee from the borrower, which means that they have personally, unconditionally guaranteed to repay this loan, which means we have that stick in the event of a default. We can say, look, you promised to pay this back with your personal guarantee. Unless you're fixing to declare bankruptcy, you're going to be liable for the balance of this, regardless of how this goes. Mm-hmm. So you want to go declare bankruptcy, go talk to a bankruptcy attorney, be my guest. I've seen that happen. It takes about 5 or 6 months. And I get on those calls with the bankruptcy trustee. And what they say on that call is, how much do you owe SEP Capital on property at 123? $425,000. Well, sell it and pay them back. Okay. Yeah. Going bankrupt does not mean you go to zero. The creditors still get priority in terms of, debt positions like recorded liens like this. A bankruptcy from this guy would not take your loan to zero. A lot of people think that that's how it works. It's not. They still have to unwind their stuff. And if they have a problem somewhere else, it has nothing to do with the lien against that property. Now, it might get sold at a discount and you might have to take a hit or whatever. But in this kind of scenario, you wouldn't, and he would still be compelled to sell that property. Now, that's no fun. I've only had to deal with that once. It was no fun. But I was in a position where, as the lien holder, I was going to be paid as a result of that sale. Now, what bankruptcy attorneys do is they look at any gain that would have come from that sale, and they would allocate that gain from the borrower into the next debt obligation that he or she has. But again, at the bottom of the debt stack with these recorded liens that we have, we still get made whole first. So that's additional protection for the capital partners. And again, what it really comes down to is there are so few ways to go to zero, as opposed to like a stock can go 80% down because something happens and a kid chokes on a toy or something. But there's a lot of there are so few factors that create catastrophic risk as opposed to alternative investments, that it makes it, in my mind, so attractive. And that's why you have so much of your personal capital in your balance sheet. That's why I have so much of my capital in my balance sheet, because I want to deploy as much of it as I can in this investment vehicle. Now, I look at stocks and bonds as diversification away from this, like you do. Most people look at it the other way. They look at a private money loan as diversification away from their 401k or their retirement accounts. And I understand that logic, because that's how most people are raised. And the vast majority of hardworking professionals look at their retirement accounts as their nest egg for the rest of their life. But there's nothing that says that you can't put a portion of your portfolio into an alternative investment like this, as long as it's a well-structured and protected investment. So if you're thinking about investing in loans in the state of Florida, you should work with Daniel. And obviously, if you're in the Michigan or Indiana area, you should call Finley Capital. But the last thing I want to talk about with you before we go is what we just did for each other, which is we provided capital backstops for each other. There's 20 or 25 very talented private lenders in our mastermind group. And at the end of that mastermind, as you know, there was some very interesting questions going on. And one of the things I thought of was, why aren't we all supporting each other in terms of backstops? And by that I mean, this is for the private money lenders listening, or the people that want to learn how to do this now. When you start originating deals, your pipeline at some point will exceed your available capital. And that's a very scary place to be. You got 800,000 in pending loans and 300,000 in available capital to lend.
Yeah.
And when you go to try to talk to your capital partners, you sound very desperate when you need $500,000 in a week. It's not a good look, right? And so one of the things that I think we should all be doing better is we should all be able to call each other and say, hey, I need $500,000 to fund these 5 deals. I got $1 million in repayments coming in the next month. Can you lend me $500,000 and invest in these loans with me? And then I'll pay you back out after a month if you need it, and work back and forth to support each other. Now that requires a lot of trust and a lot of track record and money wiring back and forth and whatnot. But what do you think of that concept? Do you think there should be more of that inside of the internal lending networks that we have?
So should is a funny word to apply to it. I think that it will happen as a byproduct of what you mentioned is trust. I mean, this was so I've been with the mastermind for all of their meetings, less the first meeting. So was this my 5th or 6th? I don't know. Yeah. 2 a year. So it's been almost 3 years, I think, that I've been a member, and it's been almost three years that I've gotten to know a lot of you guys. I think you and I connected early on because we're both kind of going through new kids at the same age. And we've done that 2 times, I think. And so,
double it.
And so so what builds, trust is just getting to know people. Like they say, like networking is just getting to know people. And I think that having the opportunity to work together on deals like you and I work together is a byproduct of just getting to know each other, understanding who Danny is, who Logan is, what are my morals, what are my values, what do I stand for, right? Are those values and morals that align with your values and morals? Do we see things the same way? And I don't think it's something that we should do, right? I don't think it's something that we should push. But I think that it's something that will come as the years go by and people maintain consistency. You really get to know people over the long term. you meet someone, you're feeling them out for the first couple of years, but they're doing the same thing over and over and over for 5, 6, 7 years. Good indication that that's who that person is. And I think that I've been in the mastermind now, like I said, for almost 3 years. And just in the last 6 months, from this mastermind to the mastermind prior, I'd never worked with anyone before that. And since that last mastermind, one of the things that I was pretty proud of was that I had the opportunity to work with 4 members of the mastermind. You provided some liquidity for us at a pretty important time and really helped us out. And then I had the opportunity to work with another member on splitting a deal in Texas, a pretty large deal that we were really proud of, super low loan to value with a famous athlete that we were pretty excited about. And then we had the opportunity through one of my salespeople to broker a couple deals to other members in the group. So I think things like that will continue to happen as we all get to know each other more. You and I, for a while, were talking pretty frequently. We still talk frequently outside of the mastermind. I talk to Jeremy and David pretty often, and so I send memes back and forth to Bryce pretty often on social media. So it's just connecting. It's connecting, and I think all of those things come as a byproduct of getting to know somebody and trusting somebody. So I think that's my take on it.
What's next for SEP Capital in the next 12 months?
Next 12 months is I've taken the hint from a lot of the guys in the group. I'm interviewing fractional CFOs. I've got my last meeting on Wednesday, and I think he's the guy. He's actually local, but part of a larger company, which I thought was important. But hiring a fractional CFO and really dialing in our financial processes and procedures. I want to get our books GAAP compliant, and I want banks to salivate over our business structure, right? And so I just want everything to be ironclad. And then, over the next year, my plan is to work with some banks to get some financing in order. Considering moving to a fund model, I know against your wishes, but consider moving to a fund model because I think there's some benefits that everybody can get from it. So I need to kind of touch base with all of our capital investors, make sure everybody's on board for that. And then I want to grow the portfolio. I need to bring on a servicer, and I need to which I think the fractional CFO can help a lot with in the beginning. And then bring on more salespeople, maybe 1 or 2 more over the next year, and just expand. I'd like to be in a year's time at above 50 million. I think that that's pretty possible. It's an interesting time. It's an exciting time in my business now because I can, our ultimate goal is to get to 150 million, which I know a few people in my market that are at or above 100 million. And there's a lot of leverage on time, and it's a big number, but it doesn't necessarily mean that there's a lot of work in terms of managing that. And so I see the runway to that. I know how to grow the business to that on the sales side. So what I need to work on is make sure that I relieve the bottleneck of capital, that we have a capital runway there, and that our systems are ironclad. I could probably grow this to about 50 million with the processes I have now. I think beyond that, those processes are going to start to break down. And so I need to look at these processes and procedures with intent and make sure, with the help of a fractional CFO who's also going to probably be somewhat of a COO, make sure that everything is just clean and airtight. And then that'll give me the ability to go out and sell, which I think is one of the things that I do better in this business.
What's the best place to learn more about SEP Capital?
You can find me on at sepcapital.com or at my website, or my email address is daniel@sepcapital.com. I'm on Instagram. I don't know what my Instagram handle is D_Paloscio, but that's my personal account. So best way would probably be email.
All right. Thanks for being on the show. Let's get back to it and let's go get them.
Thanks, man. Had a lot of fun.